Hello everyone. It is time to talk about your money. It is time to talk about your future. Many of you work so very hard. You save, you try to do the right thing. But then comes investing. That word can sound scary, can't it? It can feel complicated. It can feel like it is only for the experts. I'm here to tell you that is not true. You can take control of your financial future. You absolutely can. Let's talk about something called an ETF. ETFs have become so very popular. You hear about them more and more. There are good reasons for this. People are realizing the power of ETFs. They are seeing how ETFs can help them reach their financial goals. It is not just a trend, it is a smart shift in how people invest. Millions of people are using ETFs. They are using them to build a better future. You need to understand why. One big reason is simplicity. Investing should not feel like a puzzle. It should not require a PhD. ETFs cut through a lot of the noise. They offer a straightforward way to invest. Instead of picking dozens of individual stocks, you can buy one ETF. That one ETF might own hundreds of stocks. This makes your life easier. It saves you time. It saves you from a lot of headaches. This simplicity is a game changer. Another huge benefit is diversification. I say this all the time. Do not put all your eggs in one basket. Diversification means spreading your money out across different investments. If one investment does poorly, others might do well. This helps reduce your risk. ETFs make diversification easy. Many ETFs are already diversified for you. They hold lots of different things, so you get instant diversification. This is so smart. Finally, let's talk about cost. Fees can eat away at your investment returns. You work hard for your money. You should keep as much of it as possible. ETFs often have lower expenses. Lower fees than many traditional mutual funds. This is a very big deal over time. Lower costs mean more of your money stays invested. More of your money is working for you. This is key to growing your wealth. ETFs help you do just that. So, we know an ETF is like a basket holding many investments. But what exactly can be in that basket? This is where ETFs get really interesting. They are incredibly versatile. The basket can be filled with all sorts of assets. This variety is a big part of their appeal. It means there is likely an ETF out there, an ETF that fits your specific needs and your specific goals. ETFs can hold stocks. These are shares of ownership in companies. An ETF might hold stocks from large companies or small companies or companies from a specific country. They can also hold bonds. Bonds are like loans you make to governments or to corporations. They pay you interest. So an ETF basket can be full of stocks or full of bonds, or even a mix of both. There are many possibilities. Beyond stocks and bonds, ETFs can hold other things. Some ETFs invest in commodities. Think of gold or oil or agricultural products. These are raw materials. Other ETFs focus on real estate. They might hold shares in companies that own office buildings or shopping malls or apartment complexes. This gives you a way to invest in property without buying a whole building yourself. This variety means choice. It means flexibility. You can choose ETFs that align with your comfort level, your tolerance for risk. You can choose ETFs that focus on areas you believe in. Maybe you want to invest in technology or perhaps in clean energy. There are ETFs for those too. This power to choose is important. It helps you build an investment portfolio, a portfolio that truly reflects you. Now you might be thinking, Suze, this sounds good, but there are so many ETFs. And you are right. The world of ETFs is vast. There are thousands of them available. It can still feel a little bit daunting, even with their simplicity. Knowing where to begin can be the hardest part. That is perfectly normal to feel that way. Do not let that stop you. Please do not. That is exactly why this guide exists. We are going to break it all down, step by step, in simple language. No confusing jargon here. My goal is to help you understand the different types of ETFs, what they invest in, who they might be good for. We will look at examples, real-world examples, so you can see how they work. Knowledge is power, especially when it comes to your money. This is not about making you an expert overnight. You do not need to be a Wall Street guru, not at all. This is about giving you the foundation, the basic knowledge you need to make smart, informed decisions that are right for you, for your family, for your financial well-being. It is about building your confidence so you can take action and start investing for your future. It is your money after all. So, are you ready? Are you ready to learn more? I hope you are. This 25-minute guide is designed for you, to demystify ETFs, to show you the opportunities they offer, to empower you to take control. The next sections will dive deeper into the specific types of ETFs. Let's continue this journey together. Your path to understanding ETF investing starts right now. Alright, we have talked about what an ETF is. We know it is a basket that holds different investments. We know it trades on an exchange, just like a stock. This is good, this is your foundation. But now we need to go a little deeper, not too deep to cause confusion, just deep enough so you understand the choices, the powerful choices you have. You see, not all ETF baskets are filled the same way. They are not all identical, far from it. The beauty of ETFs lies in their variety. They can be designed to hold specific types of assets. This is so important for you to grasp. Because the assets inside the ETF, those determine its behavior. They determine its potential risks and its potential rewards. Understanding these categories is truly key. In this part of our guide, we will explore the main types, the core categories of ETFs you will encounter most often. We are going to look at stock ETFs. These invest in companies. We will discuss bond ETFs. These invest in debt. Then we will cover commodity ETFs, think gold or oil. And finally, real estate ETFs, giving you a piece of the property market. Each one is different. Knowing these fundamental categories will empower you. It will help you start thinking about what might be right for you, what aligns with your financial goals, your comfort level with risk, and your timeline for investing. This knowledge is not just for experts, it is for everyone. It is for you. So you can build a portfolio that makes sense, a portfolio that works hard for you. Let's get started. Let's begin with the most common type of ETF, the one many people think of first. These are stock ETFs, sometimes called equity ETFs. Remember, stocks represent ownership, tiny pieces of ownership in companies. So, a stock ETF is a basket filled with stocks from many different companies. It is that straightforward. You are not just buying one company, you are buying bits of many. This is a fantastic way to achieve diversification. We talked about not putting all your eggs in one basket. A stock ETF often does this for you instantly. Instead of you having to research and buy shares in dozens or even hundreds of individual companies, you can buy one share of a stock ETF. That one share can give you exposure to a broad range of businesses. This helps spread out your risk, which is very smart. Stock ETFs can be very diverse themselves. Some might focus on large, well-established companies. You might hear these called large-cap stocks. Think of the household names you know. Others might focus on smaller, growing companies. These are small-cap stocks. Some stock ETFs track a whole market index like the S&P 500, which represents 500 of the largest US companies. This gives you a slice of the overall market. So for example, if you buy an S&P 500 ETF, you are essentially investing in the performance of those 500 leading American companies, all in one single transaction. If the overall market does well, your ETF is likely to do well. If it goes down, your ETF will likely follow. It is a way to participate in the broader economy without picking individual winners. This can be a great starting point for many investors. Now let's shift gears a little. Let's talk about bond ETFs. Bonds are different from stocks. When you buy a stock, you own a piece of a company. When you buy a bond, you are essentially lending money. You are lending money to an entity. This entity could be a government, it could be a corporation. In return for your loan, they promise to pay you back the principal amount on a future date, and usually they pay you interest along the way. Bond ETFs, therefore, are baskets filled with many different bonds. Just like stock ETFs hold many stocks, bond ETFs hold many bonds. This is important for diversification too. But within the bond world, it means you are not lending all your money to just one government or one company. You are spreading that lending risk across many different borrowers. This can make your investment a little safer, a little more stable. People often invest in bonds or bond ETFs for income and for stability. The interest payments from bonds can provide a regular income stream. This can be very attractive, especially for those nearing retirement or for anyone looking for more predictability. Bonds are often considered less risky than stocks, though they typically offer lower potential returns. They can help balance out a portfolio, especially one that has a lot of stocks. There are many kinds of bond ETFs available. Some invest only in US government bonds. These are often seen as very safe. Others invest in corporate bonds issued by companies. These might offer higher interest but also carry a bit more risk. You can find bond ETFs that focus on short-term bonds or long-term bonds. The choices allow you to tailor your bond investments to your specific needs for income and your tolerance for risk. Let's explore another interesting category. This is commodity ETFs. Commodities are raw materials. They are the basic goods used in commerce. Think of things like gold, or silver, or oil and natural gas. Even agricultural products like corn or wheat. These are all commodities, things that are grown or things that are extracted from the earth. They are fundamental to the global economy. So, a commodity ETF aims to give you exposure to the price movements of these raw materials, instead of you having to buy and store a barrel of oil or a heavy gold bar, which, let's be honest, is not practical for most people. You can buy shares in a commodity ETF. This makes investing in commodities much more accessible, much easier for the average person. It opens up a whole new area of investment. Why would someone want to invest in commodities? There are a few reasons. Some investors use commodities as a hedge against inflation. When the prices of goods and services are rising, the prices of raw materials often rise too. Commodities can also offer diversification. Their prices may not always move in the same direction as stocks or bonds. This can add another layer of balance to your portfolio, which can be a smart strategy. Commodity ETFs can work in a couple of ways. Some physically hold the commodity. For example, a gold ETF might store actual gold bullion in a vault. Others use futures contracts. These are agreements to buy or sell a commodity at a specific price on a future date. These can be a bit more complex. It is important to understand how a specific commodity ETF gets its exposure before you decide to invest your hard-earned money. Our final core category for this section is real estate ETFs. Many people dream of owning property. Investing in real estate has long been a way to build wealth. Real estate ETFs offer a more accessible way, without buying physical property directly. Many of them invest in something called REITs, and they must pay out most of their income to shareholders as dividends. You can buy or sell them easily, with a much smaller amount of money, across different types and sometimes different geographic locations. Alright, we have covered the big categories: stock ETFs, bond ETFs, commodities, and real estate. These are your foundational building blocks. They give you broad exposure. This is where sector and industry ETFs come into the picture. These are more specialized types of ETFs. They concentrate on one specific segment of the economy. Sector and industry ETFs narrow your focus. They concentrate your investment. This can be powerful, but changes the risk and reward equation. Section 2. Why target a sector? Potential rewards and real risks. Why focus on one sector? Isn't broader diversification always better? It depends on your goals, knowledge, and risk comfort. Sector ETFs can offer higher growth but come with real risks. Concentrating investments means higher volatility and less diversification. It requires more research and conviction. Understand the factors driving a sector forward or holding it back. Section 3. A closer look examples of popular sector ETFs. Let's make this more concrete. Let's talk about some common sector ETFs. Technology sector ETFs hold shares in tech companies. Healthcare sector ETFs invest in health-related companies. Financial sector ETFs include banks and insurance companies. Consumer discretionary sector ETFs cover goods and services. These are just a few examples. There are ETFs for many other sectors too. Section 4. Drilling down the niche world of industry ETFs. Now, if sector ETFs are like using a zoom lens, then industry ETFs are like using a microscope. They take that focused approach one step further. A sector is broad, like technology. An industry is much narrower. It is a specific subgroup within that sector. So an industry ETF will concentrate its investments in a very small, very specific part of the economy. This is for investors who have a very precise idea about where they want to put their money. Let's go back to our technology example. A broad technology sector ETF might hold hundreds of tech stocks across many different areas of technology, but an industry ETF within technology, it might focus only on cybersecurity companies, or only on companies involved in artificial intelligence, or perhaps only on businesses that make video games. You can see how specific this gets. You are not just betting on technology in general, you are betting on a very particular niche within technology to be successful. The potential rewards here can be even greater if that tiny niche you have chosen takes off like a rocket. Your highly focused industry ETF could see spectacular returns. Imagine investing in an early-stage clean energy industry, just before it becomes mainstream. The growth could be phenomenal. However, the risks are also magnified significantly if that niche fails to deliver, or if it faces unexpected challenges. Your investment could lose a lot of value very quickly. There is very little diversification. Therefore, industry ETFs are generally not for beginner investors. And they are usually not for the faint of heart. They require deep knowledge and a very strong conviction about that specific industry's prospects. It is like being a specialist doctor. You need to know your area inside and out. Most people are better off with broader diversification. But for those who do their homework and understand the extreme risks involved, industry ETFs can offer a way to target very specific growth opportunities. Carefully is the word here. So far we have talked a lot about investing, about ETFs that focus on companies or bonds or commodities or real estate. Often when people start investing, they think locally. They think about companies in their own country. This is understandable. It feels familiar, it feels comfortable. But I want you to think bigger. I want you to consider the whole wide world, because your financial opportunities should not stop at your borders. International ETFs are your passport to global investing. It is that simple. These are exchange-traded funds, just like the ones we have discussed. But instead of holding assets from just your home country, they invest in companies or bonds from other nations all around the globe. This means you can own a piece of businesses in Europe, in Asia, in South America, or Australia, all with a single purchase through your regular brokerage account. It is truly amazing. Why should you even look beyond your own shores? That is a fair question. Think about it this way. Your home country's economy, no matter how strong, is only one part of the global economic engine. There are many other countries with vibrant economies, innovative companies, and strong growth potential. By only investing domestically, you might be missing out on significant opportunities for your money to grow. Diversification is key, remember? This part of our guide is dedicated to these global adventurers, these international and emerging market ETFs. We will explore what they are, how they can benefit your portfolio, and very importantly, the unique risks they carry, because with global reach comes global responsibilities. You need to understand these to make smart, informed decisions for your financial future. Let's open up the map and see what is out there. It is time to broaden your investment horizons. First, let's talk about developed markets ETFs. Developed markets have mature, stable economies. Think Germany, France, the UK, Japan, and Canada. These ETFs hold stocks of large, well-known companies. They offer diversification and stability. But be aware of potential downsides like currency fluctuations. Now, let's shift our focus to something very different. Emerging markets. ETFs offer excitement and higher rewards. These funds invest in rapidly growing developing countries. Think of dynamic nations like China, India, Brazil, and Russia. These economies are expanding quickly, offering high potential returns, but with high rewards come high risks. Emerging markets are volatile and politically unstable. Proceed with caution. So, we have explored ETFs that look beyond our own borders, international developed market ETFs, and the faster-paced emerging market ETFs. Investing globally through ETFs has clear benefits. It's like opening windows in your investment house, letting in fresh air and new opportunities. Enhanced diversification is a key benefit. Your home market is just one piece of the puzzle. It won't always be the best performing. Access global growth engines. Emerging markets grow faster than developed ones. Participate in these dynamic regions, tap into new consumer trends and technologies, and burgeoning industries. Prospects not in your home market, boost long-term returns, act as an insurance policy, hedge against domestic market problems. No country is immune to downturns. Spread investments across countries, cushion your portfolio. Some markets thrive when others struggle. Smart defensive financial planning. Many leading companies are not based in your home country. Invest in global champions. Think about dominant global brands. ETFs simplify global investing. Avoid the complexity of foreign stocks. ETFs make global investing accessible. Investing globally is not a one-way ticket to riches. It comes with its own unique set of challenges. The first major risk is currency risk. When you invest in an international ETF, your money is often used to buy assets denominated in a foreign currency. If the value of that foreign currency has fallen relative to your own currency, your investment returns will be lower. Next, consider political and economic instability. This is particularly true for emerging markets. Governments can change, new laws can impact businesses, and economic crises can erupt. Finally, be aware of differences in transparency and regulation. Proceed with knowledge and proceed with caution. Now we're going to explore something quite different: thematic ETFs. These funds are about big ideas and powerful trends shaping our world. A theme is a significant shift in how we live or how business is done. Thematic ETFs try to capture companies well-positioned to benefit from these transformations. Think about the future of finance, including companies working on blockchain technology or digital payment solutions. This approach can be incredibly appealing. However, because these themes often involve newer, less proven concepts, thematic ETFs come with their own unique set of risks. You must understand this before you jump in. It is a very forward-looking strategy. Align your investments with progress and innovation. The landscape of thematic ETFs is constantly evolving. One prominent area is disruptive technology, including AI, robotics, and fintech. Another major theme is sustainability, focusing on clean energy and ESG principles. Demographic shifts also provide fertile ground for thematic investing. Consider the aging population in developed countries or the economic impact of younger generations. Evolving lifestyle trends inspire thematic ETFs like e-commerce, pet care, and e-sports. Some thematic ETFs focus on newer industries such as cannabis-related businesses. The core idea is to invest in companies benefiting from changing consumer preferences. The challenge is distinguishing between a lasting trend and a short-lived fad. Spotting trends can be fascinating. Niche ETFs take targeted investing to an entirely new level. They are hyper-focused, often holding shares in only a handful of companies. The primary allure is the potential for explosive returns. If that tiny niche takes off, the returns could be massive. However, the danger is equally massive. Investing in such a narrowly defined area means abandoning most principles of diversification. If the niche fails to materialize, your investment could lose substantial value quickly. Imagine an ETF focused on a specific technology that becomes obsolete overnight. Your entire investment is tethered to the success of that single niche. This is like placing all your financial eggs in one tiny fragile teacup. You must approach these types of investments with extreme caution. They should only represent a very small portion of your overall well-diversified investment plan. This must be money you can afford to lose entirely. Foundational financial goals must always come first. Do your homework and understand the specific theme or niche in great depth. Read the ETF's prospectus thoroughly and know exactly which companies it holds. Pay close attention to its fees. Do not chase hype or hot tips. Many themes sound compelling on paper but do not always translate into profitable investments. Your ultimate goal is achieving long-term financial security. The cornerstone of smart investing is diversification. ETFs help you diversify by holding many different investments. When you buy shares in a broad stock market ETF, you're buying small pieces of hundreds of companies. True diversification means owning different types of assets. This includes stock ETFs, bond ETFs, and international ETFs. Each asset class behaves differently, which is good for your portfolio. Spreading your investments across various types of ETFs builds a resilient portfolio. This helps to smooth out the ride and protect your overall wealth. It's about building sustainable wealth for the long term. This is financial peace of mind. The key concept here is asset allocation. This means deciding on your mix of different investment types. How much will you put into stocks for growth? How much into bonds for stability and income? You can use a few carefully chosen ETFs to achieve your desired asset allocation. A simple core portfolio might include a broad US stock market ETF, an international stock market ETF, and a broad bond market ETF. Your ideal asset allocation depends on your age, financial goals, and comfort level with risk. If you're younger, you might choose a higher allocation to stock ETFs. If you're older or have a lower tolerance for risk, you might want a larger portion in bond ETFs. The key is to create a mix that aligns with your unique financial journey. Stay invested through thick and thin. Section 3. The cost factor. Why every penny counts with ETFs. Costs, fees, expenses. They matter a lot. Every dollar you pay in fees is not working for you. It is not growing or compounding. Fees are like tiny leaks in your investment bucket. Over years, they can drain your wealth. Pay attention to costs. Look for the expense ratio. Lower costs mean more of your money stays invested. It is a gift to your future self. Always check the expense ratio before investing. Section 4. Long-term success. Key habits for ETF investors. Investing is not a sprint, it is a marathon. Key habits can help you succeed over time. Dollar cost averaging means investing a fixed amount regularly. This reduces your average cost per share. Rebalancing keeps your portfolio on track. It manages risk and aligns with your goals. Stick to these habits for long-term success. Section 1. Your ETF journey. Knowledge is your power. We have come a long way on this ETF journey. You have learned about different types of ETFs. You are more prepared to make smart decisions. Knowledge is power when it comes to your finances. Use it well. Section 2. Taking the next steps. Investing wisely for your future. Start smart with what you are comfortable with. Begin with a small, manageable amount. Investing is a marathon, not a sprint. Patience and consistency are key. Do your own research. Never invest in something you do not understand. Choose low-cost ETFs for core holdings. Create a plan based on your financial goals. Build a diversified portfolio and stick to it. Avoid chasing hot tips. Consider dollar cost averaging and rebalancing. Make informed choices for a secure future. Apply these lessons wisely. Build the financial life you want.